In this video, I want to review the earnings from MSCI Q2 2025. The day they reported, the stock dropped 9%. So is it a good time to buy? Do you have any red flags? What are the reasons why the stock dropped 9%? I will tell you everything in this video. I think this will be a pretty long video. We will talk about the press release, the slides, maybe the earnings calls. I will get you some charts, some comments, because I am a shareholder of MSCI. I've been a shareholder of MSCI for a few months now, and I'm doing some deep research on the company. I think it has the potential to outperform the market, which is the reason why I am invested. In case this is your first video from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. My portfolio is public. You can check my stats. You can check my website. All the performance is here. And the goal of this YouTube channel is to help you become a better investor. Okay, and now I want to show you how I review MSCI, because not a lot of people understand this company. Strangely enough, it's a big company, right? But people don't really understand what they do. They compare it with S&P Global, and I don't think they are they are the same actually. I don't think they are the same. S&P Global has a big rating segment, which MSCI doesn't have. So we will talk about plenty of topics, and maybe this is the only video you need to understand the latest earnings report from MSCI. So if you like this kind of content, leave a like to the video so I can do more of these kind of updates. Okay. If you click on this video, normally you know what MSCI is, you know what they sell, but let me do a quick recap in case you are new to the company. It's a market cap of $40 billion. The company was created in the 80s, 90s. It's a spin-off of Morgan Stanley in 2007. And they have the same CEO for decades and decades, Henry Fernandez. That is the largest shareholder when it comes to insiders. Okay, so the CEO owns 3% of the company, of MSCI. And this is a company about software. Half of the company is the index segment, the benchmark, the MSCI World. They sell this. It's pretty recurring. You compare your portfolio, your performance with the MSCI index. So this is purely recurring for asset managers. Then, I can show you what I mean. If you look at the financials, you look at segments and KPIs. Here is the index part. I'm on Fiscal AI right now. I can show you the different segments and the allocation, whether this segment is big or not. You can click on this comment size, and you see that the index operating revenues are 55% of the total revenue. So half of the business, that's the index. They sell the index segment, which is pretty recurring. Then you have the analytics segment. So software, tools that you give to portfolio managers to estimate risk metrics, risk-adjusted metrics, what moves your portfolio, etc. So plenty of software analytics tools, and this is 23% of the total revenue. So half of the revenue index, 25% of the revenue analytics, and what about the remaining 25%? It's sustainability and all other. Sustainability is the ESG part. So portfolio managers want to know more about what they own in their portfolio, the ESG, climate, sustainability metrics, scope 1, 2, 3, etc., etc. So that constitutes 11% of the ESG, of the revenue. And you have this, all other private assets. This is private equity. That's 9% of the revenue. These two segments are not really important. What moves the needle for MSCI are the index segment and the analytics segment. Guess what? These are the most profitable segments for MSCI. So it's good that they are big. They are big and they are the most profitable segments. Let me show you all the margins. Oh, there was an update on Fiscal AI. I can't show you the margins for ESG and private equity, but I remember them. If you look at the margins for the index segment, so half of the revenue, that's 75% EBITDA margin. And for analytics, 25% of the revenue, that's 50% EBITDA margin and growing. And for ESG, it was 30% EBITDA margin, and private equity a little bit lower than 30%. So I want to finish this quick introduction by telling you they have 4 key segments, but the biggest ones are the most profitable ones. Okay. And so now you understand what they do, you understand what they sell, they have international exposure. But let me start with the slides. I'm here on Fiscal AI, you click on Investor Relations, on Slides, and you put the full screen. Okay, what can we get here? You have a few slides. This is the CEO, Henry Fernandez, that has been here for decades and decades. And here are the stats. Don't worry, maybe you have seen some other YouTube videos talking about these slides. In this video that you are watching right now, we will go much more deeper. But I need to start from the starting point, right? So maybe you've seen these slides. Don't worry, we'll go much deeper after this. What you can get here is in Q2, the revenue has grown 9%, organically 8%. So no acquisitions, no things whatsoever. It's only recurring. I started this video explaining you the segments, so it's deeply recurring. Add to this more EBITDA margin, better margin expansion. We'll look at this a little bit later. They produce $300 million of free cash flow, and they use these $3 million to do buybacks and to do some dividends that you don't see here very well. So revenue is going up 9%. Operating income is going 11%. The difference between 9% and 11% shows better margins, better efficiency. So maybe the business is not becoming a growth beast, but it's getting more efficient. The second difference you see is between operating income of 11% here at the right, and where is the net income? Net income or diluted EPS or adjusted EPS should work. Look at this, 11% versus 15% for the adjusted EPS. The difference here, that's the net income, interest, taxes, and that's the buybacks. So you are in a perfect scenario. This is also what we see on, let me draw, on our clients in my coaching program. The best scenario for stocks is you get revenue growth, that's a R, that is lower than the EBIT growth, operating income, that is lower than the net income growth, that is lower than the earnings per share. This is very important, and I want to make a point here. What it means is you have a revenue of 9% per year. Sorry for the writing, I have a computer mouse. That is getting lower than 11%. The difference here is better margins, better efficiency, and I will explain for all the segments how they increase their efficiency. Don't worry, I've seen 0 videos about this on YouTube or on Twitter, but you will see why margins went up this quarter. I think management is doing the right thing here to not necessarily focus on growth, but focus on efficiency. And I will tell you why. Okay, now if you compare the EBIT to the net income for the company should be like 13%, 14%. Okay, 14% for net income. And we had 14% growth. Earnings per share of 15% growth. Sorry for the bad writing. What it means is they become more efficient. They deal better with their taxes and interest rates. Okay, interest payment because of they have debt, and they do buybacks. These are the 3 things that are changing between these two, the 9% and the 15%. You start from the foundation of 9% and you build up on efficiency and buybacks and capital allocation and good management team. You go from 9% to 15%. Very few companies can achieve this status of growing their earnings per share by 15% consistently. And guess what? This company has been doing this for many years. This is my starting point of my foundation. And this is why I believe MSCI can be a long-term compounder. If you look at the financials, the fundamentals, you look at the revenue, you look at the EBIT, you look at the net income, and you look at the earnings per share. Here is what you can get. I'm using a website called Stock Unlock here. You have a discount code in my description. If you want to use this tool, it's a wonderful tool. I'm using this on a daily basis. Same thing for Fiscal AI here. It's a wonderful website. I'm using both of them on a daily basis. You have discount codes in my description, like you get -10, -15% off. So it's a discount for you. What you can see is for the past, let's say for the past 10 years, right? June 2015. What you can see here is the revenue for the past 10 years of MSCI has gone up by 11% per year. That's the CAGR, compound annual growth rate, okay? The revenue was 11%. The EBIT growth was 16%. As I showed you previously, they grow more because of more margins, more efficiency. And then what's the line after this? We talked about net income. Net income has grown by 19%, 20% per year for the past 10 years for MSCI. Add to these share repurchases, the diluted EPS have grown, earnings per share have grown 24% per year for the past 10 years. Can you name 10 businesses that have this kind of beautiful growth? This is a sign that the revenue is only growing by 9, 10, 11%, not a lot of growth. But it's an efficiency beast, and the management knows how to improve their margins, and the management knows how to allocate capital to improve the earnings per share. And over the very long term, stock prices follow earnings per share. So this is why I invested in MSCI. I invested in MSCI because it has the potential to grow earnings per share at 24% per year, which means the stock price can go up by 24% per year for a sustained period of time. And if you play around with the time, you will get different numbers, but the story is the same. More efficiency. It's an efficiency beast that is getting better and better. Look at all the charts. Look at the diluted EPS. It's literally up and to the right. Up and to the right. You don't have this with other companies that are more cyclical, including S&P Global, by the way. So I wanted to start this video by showing you this efficiency beast, and this is a very good point. Let me continue with different slides because you have some value over there. Okay, very well. Now they talk about the regional performance. They talk about Americas, Europe, and Asia Pacific. Everything is growing growing nicely, but they generated a little bit of decreasing recurring net new subscription sales. What it means is they generated new sales on every region. Look at this, plus 19 million, plus $16 million, plus $10 million. But the growth rate for additions, new clients, was a little bit slower than in the past. It's not a decline, right? What you see here, year-over-year growth of 15%, it is not a decline. It's a deceleration for the recurring net new subscription. And I saw some people saying that is the reason why the stock dropped 9% in one day. And I saw again some people saying it's the first time ever that MSCI has experienced a deceleration in their addition of new clients. Next question for you is, have you checked the past metrics, the past reports? Because I can tell you, it is not the first time you have a deceleration. And I took all the past slides. Normally I have everything here. No. Where is it? Do I have them here? I want to show you what I mean. I don't want to tell you, I want to show you. Okay, so this is this report of this quarter. You have a deceleration. It's a minus, and a flat. Look at Q1 2025. It's a plus. Okay, let me Q4 2024, flat, minus. So again, we find another quarter when you have a deceleration of earnings. So it's not the first time it happens. Let me continue. You look at Q3 2024, plus, minus, another deceleration. Again, 2024, Q2, plus, minus. Again, another one. Oh, here we go. Q1 2024, it was a triple minus. Minus for Americas, minus for Europe, minus for Asia. So it happened in the past. Guess what? In Q1 2024, when they announced this report, the stock dropped, I think it dropped 13% in one day. and it immediately recovered after this. Guess what? When they reported Q1 2024 and the stock price dropped 13% in one day, 2 days after this, the CEO, Henry Fernandez, bought more shares in his personal portfolio. The records are public. You can check this. The stock dropped. 2 days after this, he bought a lot of shares. So it is a panic move. Frankly, I don't know how to put it. It's a panic move. So again, let me continue. Plus, minus, plus, it's flat. Minus, minus, plus. In, what was it? 2023, Q3, again, it was a deceleration. I can go on, and you have plenty of examples. Here we go. Q1 2023, again, it's a minus, 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 a clear deceleration across 3 different regions. So please, when you see something on the internet saying that it's the first time ever that we have the deceleration, please don't, please make up your own mind or watch my videos or do whatever you want actually. So this is, I believe, the reason why the stock is down. One of the reasons the stock is down. You have other reasons, right? But I wanted to assess this point saying this is a panicky move. This is not the first time it happens. And most of the time it has recovered, okay? Second thing, now they talk about additions of new sales coming from America. That is minus 15% here. It corresponds to an addition of new clients, new revenue of $19 million. Please take into account the size of the addition. Only $19 million. Compare it with the total revenue from Americas of $1 billion. It's not the same thing at all. So I believe to some extent this is irrelevant to the thesis of MSCI. This is a move caused with panic. People saw a decline. They saw that first it was a decline. It's not. It's a deceleration. They thought it's the first time. No, I showed you it's not the first time it happens. 3, they say it's big, it's important. No, it's only a small percentage of the total revenue. Okay, let me continue. If you look at the reports and all the regions, the different segments, everything is moving up. The MSCI overall is going up, total run rate plus 10% organically, no acquisitions whatsoever. The index is going up by 12%, the analytics 7%, sustainability 7%, and this one is 6%. Don't worry, I will show you other graphs before. This is the clients. You have different clients for MSCI. Yeah, this is important. You have 50% of the revenue of the clients that are asset managers, and you have the rest. Asset managers, I can summarize the earnings call. Asset managers are not growing that much. They are growing by only 6% or 7%. Lower than expected, right? MSCI overall is growing by 10%, and the biggest client segment is growing by 6%. So it's a drag on the overall performance. The majority of the questions in the earnings calls were about asset managers. Do you plan to continue to grow, or is this a deceleration? And the management said, yes, we have a deceleration in our biggest clients, the asset manager segment. We don't see any catalyst in the short term, so we don't know what will be the growth rate in the future, but we are investing massively, heavily to grow the other half of our clients. So we want to grow in hedge funds, wealth management, others, asset owners and consultants, and banks and trading. So no major catalyst for the short term, but they are okay. I mean, if you are in a panic mode when you only grow 6%, this is pretty good. I can pay for this. That is maybe another reason why the stock is down 9%. This report. I'm recording this video, it's the next day. So it's Wednesday 23rd. So the stock is rebounding a little bit, but it doesn't change the thesis. Let me continue. Now you found the reason why the stock was down. 2 reasons. Still, everything is going in the right direction. Everything is increasing. The year-over-year change is great. I said they had great margins, better margins everywhere. For all their segments, everything is growing nicely. Let me scroll down a little bit because I want to show you something else here. This is the track record of the company. people panicking right now maybe don't have an understanding of the track record. Look at this. I love this kind of slides. I love slides when companies show you the past 15 years of operations. Not only the past 2 years, but the past 15 years. What you can see here is you have a clear trend. The AUM CAGR, so compound annual growth rate, has been 19% between 2008 to 2025. No big deal at all. This is a clear momentum. Another slide about the debt. Also, there is a clear misunderstanding when it comes to MSCI, and people say they have some debt. If you go to Guru Focus right now, you will see this is a company with great margins, 80% gross margins, free cash flow margin of 50%, and they will see the revenue up and to the right, net income up and to the right, wonderful, and they will tell you that they have some debt. They have $4 billion of debt, and MSCI can generate $1.5 billion of free cash flow. So in 3 years, they can pay off their debt. Another point that you can note is they have stopped getting more debt in 2022 when interest rates started to increase. Another sign that management knows what they are doing with the debt. And if you look at the debt levels, you see that total debt is $1.5 billion. And the next maturity when they have to repay the debt is in 2029. So they have 4 years without any repayment for the debt. They are in a safe zone. We are not in panic territory. They don't need to repay the debt now. They have 4 additional years to live with this debt and do whatever they want with the money. It would be a mistake to pay off your debt right now, especially given the inflation rate right now. So you have a strong balance sheet, provides optionality. Next maturity is not until 2029. Discipline, blah, blah, blah. Okay, so you have to start this, and the net debt to adjusted EBITDA ratio is 2.3. You see in the report, maybe we'll talk about this later, that since 2015, the debt level of MSCI has changed. Since there was an activist called Value Act in 2014, 2015. So I can show you what I mean. Since 2015, the company got more debt. And there was a clear target of having net debt to EBITDA of 3.5. Net debt. Let me show you what I mean. Look at this. MSCI was a company without much debt. And then in 2015, they had an activist which increased the debt level. And you have some leverage to do more buybacks. This is the goal of the debt, right? So they took on more debt to do some buybacks. It was good for the shareholders. And the clear target for the net debt to EBITDA ratio was 3 or 3.5. And now it's at 2.5. Look at this. This was their target. You know what? Let me show you. Let me find the debt here. This is the report. Total amount of debt was $4 billion. The total debt to adjusted EBITDA ratio was 2.5. MSCI seeks to maintain total debt to adjusted EBITDA in a target range of 3 to 3.5. So the long-term target for MSCI is to have more debt. So maybe I think now they are waiting because interest rates are high. But if the Fed cuts interest rates, it will be the first company to jump and to take more debt, to do more buybacks. So actually, it's investing in MSCI right now is investing in a call option for more buybacks if the Fed cuts rates. Okay. And as I told you, the debt level did not move since 2022, but the EBITDA went up. So this ratio is going down, okay? They are becoming more profitable with the same amount of debt. So the debt is not an issue at all for this business. Let me continue. What can I show you? I don't know. What page was I? This is the guidance. The guidance was not changed. They can generate free cash flow of $1.5 billion. So they can repay their debt very easily. Not how little the capex is. It's very, very little. They don't need any costs. They don't need any capex to continue to grow. They don't change the capex. And now we'll talk. Another reason why the stock was down, in my opinion, is the retention rate was down. If you look at this slide, you know what? Where can I put here and my face at the same time? Here, like this. Okay. This is MSCI. These are the key operating metrics, the recurring resubscription rate. One, I told you, organically, the growth is down. It's 7%. That can be a little bit spooky to investors. So maybe this is the reason why it's sold off. Two, this is the quarterly retention rate trends, oscillating between 93% to 96%. And now it dropped a little bit. And you have short sellers that jumped to this opportunity and said that this metric was bad. What a horrible quarter. The 9% decline was justified. Guess what? This is a short seller called Spring Point. And I read their thesis. So you have some short sellers. Spring Point had a short seller analysis in 2023. MSCI Spring Point short. Yes. Short position. Here we go. Date 2024. So this short seller fund hopes that the stock price drops. And if you listen to them, MSCI is a fraud that needs to be cut in half. And they tweeted a couple of hours ago that it was a horrible quarter because the retention rate was down. Well, I don't see what they see, but it was down from 95% to 94%, and I don't see this to be a big deal. So again, another bearish argument that I disagree with. Maybe they are wrong, maybe I'm wrong, but I still don't see why you have some panic. Another thing I want to show you is another reason why the stock dropped. It's because of this green line here. You have the year-over-year recurring subscription run rate growth as reported and organic. What is important is the organic. So in green, this is the organic growth rate. And let's put it this way. In 2022, you had an organic growth rate of 14%. I mean, not a lot of businesses can grow organically by 14%, which is nice. And now we are in a downtrend, 14% to 10%, 9, 8, and now 7%. Wow. It's a horrible downtrend. My next question for you is, have you checked this trend before 2020? And do you know the reason why it is dropping? Don't worry, I did the work for you. Don't worry, I did the work for you. Let me check what I have here. Oh, no. If you think 7% is bad, please check the history of the company. I went through different slides of the track record of the company in the past, and you have a slide showing the organic growth run rate from 2015 to 2020. Because I mean, if you only look at this, you have the data. If you only look at the latest slides, you have between 2020 and 2025. So only 5 years, but the company is 20 years old. So why not look at the long track record of the history? Let's see if 7% is bad. It's horrible. Let's see. Between 2015 and 2020, the organic run rate was in orange. It was at 8, 7, 7, 8, 7, 8, 9, 10, 10, 10, 10, 10, 10, back to 9. So it's not the first time we have 7%. We already had this in 2016. Next slide for you. You have the same thing between 2013 and 2017. I did some research for you, so you don't have to. Let's look at the below here, the organic subscription run rate in gray, below, in gray, in blue. In 2013, it was at 4%. Now, here we are, back to 7%. So, it's not the first time we have 7%. And maybe that's a low point in this range. What if this is the bottom for organic growth rate? And what if it rebounds beautifully from there and next year you go from 7% to 10%? What do you think the stock price will do? So maybe this is the bottom, it will rebound. Maybe it will continue to trend down, but I want to show you it's not the first time it happens. And for the past 10 years, since 2015. Every time it dropped to 7%, it rebounded. So in terms of odds, in terms of probability, the business has not changed whatsoever. It's quite likely it rebounds. So I don't buy the argument of it's the end of the world. What do I want to show you? I want to show you no. Oh yeah. What is the reason, in your opinion, the organic growth rate is down 7%? Have you checked some things on the internet? Because I did. And in 2020, the organic growth rate was at 10% in green. It went up in 2022 to 14% organically, and now back down. You remember a couple of minutes ago, I talked about the different segments the company had. What is who is the culprit? Who is at fault here? Okay, let me check the organic growth rates for the 4 segments. Okay, let's start with the index segment, and we can see if we have like an uptrend until 2022 and then a downtrend until now. Let's look at the green line for only index, right? Half of the revenue, so half of the segments. Subscription run rate was at 10% in 2020. Then in 2022, it was at 13%. Okay, so maybe it explained this. And now we are back to 9%. A small change. Okay, maybe it partially explained this. Organic analytics right now. Let's look at the organic run rate for analytics from 6% to 8% to 7%. You go from 6 to 8 to 7. It's not a change at all. Next one, you have sustainability and climate. Wow, what is that? What is that? You have an organic run rate that went from 27% to 50% organic growth rate, back to 7%. This is your culprit. This is your fault. This is the fault of the ESG segment. And just for the sake of the exercise, let's do the other one. The all other private assets organic run rate in green. It went from 8 to 12, back to 8. So little difference. But I told you the private equity segment is such a small part of the revenue. It doesn't make any difference if you move only a few percentage. The ESG segment is 10% of the revenue. But it widely fluctuated. So now you know the answer why the organic revenue was back to 7%. One index that went up from 10 to 13 back to 9. And that's still good. I mean, growing organically 9% is amazing. For a sustained period of time, it's amazing. And it is the reason why you have a high multiple for MSCI. And the second culprit is the ESG part. ESG segment that was going fast, even in 2017, it was going 20% per year, 30% per year. And you have a peak of the ESG hype in 2022 that went up 50% per year. And since then, it's decreasing and decreasing and decreasing back to 7%. Now you have two ways of looking at this. Either you say, we are screwed. MSCI was an ESG play. If ESG is not dropping, maybe it will continue to drop. And maybe MSCI is doomed because they invested so much in ESG. Or you can say that MSCI has benefited widely out of the ESG boom. And now they are turning to become more profitable. If you look at the ESG segment, where is it? That's a percentage share of the revenue. In 2019, it was 6% of the revenue. And then the ESG segment became big and it was 11% of the revenue. Since 2023, this segment is not growing anymore when it comes to percentage of the revenue, right? Look, this was, I want to see the percentage change. Look at this. In 2020, the business was growing 22% per year. The revenue of the ESG segment. In 2021, it was peak, then back down, back down, back down. Look at this. Boom. Exactly what we see on the slides. And now you have no growth, 10% growth. But remember, guys, I showed you the profitability. Too bad it's not working because it's on an update. But the margins for the ESG segment are lower than the index and analytics. So maybe it's not a bad thing that a segment that is not really profitable is not really growing. You want to get your most profitable segments to be more important, more growing. So maybe you want to reallocate your resources. And I've seen 0 videos talking about what I will show you. On Fiscal AI, you can go to Investor Relations. You will have the reports, but you will have some conferences and some transcripts. Not a lot of people read the transcripts, but I'm reading these transcripts. You have here investor presentation, another conference, and the CEO is talking, the CFO is talking, another manager from MSCI is talking. And the message that they said in May 2025 is, we see that the ESG segment is not hype anymore. So one, we will rename the ESG segment. Let me show you the proof of what I mean. In the last quarter, like Q1 2025, they renamed the ESG segment. Where is it? Where can I show? ESG. Oh, ESG. Here you go. Beginning in the first quarter 2025, the business segment, previously titled ESG and Climate, has been renamed to Sustainability and Climate to more accurately reflect the full scope of our solutions. And also, the ESG word became politicized. I don't know how to say this. Became political, right? So they want to move away from politics for good reasons, and they just say, okay, let's not only target ESG, but more a broader segment like sustainability. They want to shy away from ESG. And second thing you can note on these transcripts of conferences is the management team is clearly telling us, the public, they don't want to invest as much in the ESG segment. They want to focus more, invest more heavily into the most profitable segments. This was what they said in May 2025, and the website is having an update, so I can't show you what I mean, okay? But if you use Fiscal AI or you plan to use it in the future with my discount code, you will find this in a couple of days. It will be available. So they say we want to reallocate our resources from ESG to index and analytics, the most profitable segments. And guess what? This is exactly what they have done. If you look at the report, you scroll down on the report. I have the report here. Report, download the report here. If you look at the report, you can see the costs for every segment. You can scroll down and see this. Okay, let me zoom in. You can see this anyway. Look at this in the left. The index segment. You have 4 key segments, right? But the index is the crown jewel, the most important one. In the past, they generated some revenue and less cost. This is the reason why you have such a big margin. But if you go through the conferences, they say we want to double down the investment in our crown jewel, the index segment. So we want to implement custom indexes. We want to have a better relationships with our customers. We want to give more value. We want to invest heavily in the index segment so that customers are really happy. Well, are you doing what you say you will do? Let me check. You have, for the index segment, total operating revenues going up 9%. And adjusted expenses, EBITDA expenses, plus 9%. They are growing their costs more rapidly than the revenue. You don't have a lot of quarters when they do this. I did the track record. I did the analysis before. Most of the time, they follow each other. But now, apparently, they are investing heavily into this segment. So margins are decreasing from 77% to 76%. Oh, what a danger. What a panic mode. No. They are just heavily investing in custom indexes. So they are walking the talk. Next points. They say they will reallocate resources. Let's see if they reduced the cost for all the segments. Let's look at the analytics segment. You have total operating revenues that went up 7%, sorry, and total adjusted expenses up 1%. They grew by 7% without any costs. It's a pure profit play. They scaled back on the investments. Let me continue to another segment. The ESG segment, sustainability or climate. The total operating revenues went up 11% and the adjusted EBITDA expenses went up by 2%. They scaled back on the investments and the costs. So all these margins are going up, more profitable. They stopped investing heavily into these segments. They reallocated their resources, their costs, towards the crown jewel, the index. Okay? And by the way, I saw some people on Twitter saying this is a red flag because costs are going up more rapidly than revenue. I suspect these people have not checked the calls, the conferences before. Same thing for private assets. You have 10%, 8%. Yeah, well, the impact is a little bit lesser, but that's fine. Now, with all this change between revenue growth and expenses growth, what are the margins of this segment? Normally, you should have margins that will go up, right? Let me check. The website is having a maintenance right now, but I can show you something. Okay, I know what I will do. Segments and KPIs. No. Custom metrics. On a quarterly basis, what do you have? Okay, I know what I will do. That's the index EBITDA margins. That's your analytics EBITDA margins. Very high. And the index, extremely high, if you want my opinion. The index is fairly stable because it's so high. And look at this. The analytics segment is having margins that are almost at all-time highs. Next point, I want to check the margins of the other segments. Yes, these are not working, but can I create this just for this video, just for you guys, so you don't have to. I want to check the revenue for sustainability and compare it with the EBITDA for the sustainability. So let me show you how you can create a custom metric. This is something that can be pretty useful to you. Sustainability EBITDA margin. So I want a percentage. You want sustainability. Is it working? Is it working? Because this morning it was written ESG. No, it's not written it's written ESG. Too bad. Let me try again. I don't think it will work, guys. You have to do it yourself. Let me check. ESG. No, it is not working. Okay. So the best thing I can do right now is to calculate it by hand. And you will see the sustainability revenue. This is the ESG segment. This is the revenue. No, this is the EBITDA, sorry. You have the revenue that is here, and you have the EBITDA that is here. EBITDA reached all-time highs for this business. And if you calculate the margins between the two, I'm guessing you will have the highest EBITDA margins ever. Let me compare this. Consolidated, all other. The ESG margins went up from 30% to 35%. 5 points of margin expansion, which is very good. Actually, this is very good. Now we are just scaling this model. Same thing for analytics. The margins went from 49 to 52. Very, very good. Very, very good. And what are the margins for private assets? I said a little bit lower than 30. Yeah, it went from 26 to 28. All the margins are expanding. And my second guess is, if you look at the common size and you look at the revenue for all the 4 segments, I told you they want to reallocate the resources towards index and analytics, right? Mostly index. Look at the percentage of revenue for each segment. This is the index, 50% of the revenue. This is the analytics, 23% of the revenue. What about the other 2 players? In orange, you see the ESG segment. And this is the allocation of the ESG segment compared to the total revenue. What you see is they scaled up the ESG segment. Before it was 6% of the revenue, up to 11% of the revenue. Since 2023, they have stopped investing massively, I would say, stopped growing, and it is stuck at 11% growth. My strong guess is they will not invest massively in ESG in the future as massively as in the past. So the ESG segment will stay around 10 or 11%. Same thing for the private equity stuff, by the way. You have the same trends. And they will focus on improving the margins. So my strong guess is overall margins will move up. They will reallocate resources when they have the best margins while improving the margins for the lower segments. So better margins everywhere. And this is what is shown as a consolidated basis, better margins. I think they will continue this way. I mean, this is what management is telling us. Let me show you some other things on the slides. On the slides. No, nothing really relevant. What did they do for the cash flows now? Let me go back to the press release and let me scroll up. We've covered a lot of ground already. This is the run rate. This is the expenses, headcount. Yeah, okay. Something I've never seen anybody talking about this. I told you that management at the beginning of 2025 said they will focus. Oh, here we go. We have the transcripts now. Did the website have an update right now? Are the segments working? Well, let's see. No, they are not working. Okay, so maybe it will come in a few hours. But we have the transcript, the Bernstein. You can click on AI summary and they will tell you what they plan to do. Custom indexation, international pricing strategy, blah, blah, blah. Okay, you can check this for all the conferences and you will have a private interviews that will give you a lot of information. In these presentations, they said, 1, you plan to reallocate your resources towards your big segments. And 2, we want to use AI to reduce costs and to improve efficiency. And custom summary, can I see if I type AI, Control F, AI, where is it? No, maybe it's not on this conference, it's in another one. You have a moment, a paragraph, where somebody talks about AI. We are using AI to basically look at clusters of returns, which may be a little more volatile and transient. But no. Fundamental factors. If I don't find it, so be it. The use of AI has made it enormously more efficient to do that. The goes to the point is cost going to expand. You know, we've taken a category where quite literally, like last September, October, we had no use of AI. And with the AI, we are able to read thousands of documents, parse them, and then present that data to an analyst in a way that, you know, is enormously efficient. Sorry for my accent. So what they're telling us is a lot of work will be done internally with the AI because MSCI has gathered 20 years of data. They have the track record. This is also part of their moat. MSCI has a lot of data, so they can put everything internally with an AI assistant and make customers happy. And it will be good, efficient information. And they don't need employees to do that. If you look at the headcount, the number of employees has grown 2% year over year. Is this year over year? I think it's year over year. Let me remind you, revenue is going up 10% organically, earnings per share 15% organically. All of this while not having any cost, no new employees. Again, any investor in MSCI right now is buying a call option on efficiency with AI. Maybe they will not need as much employees in the future? What if they cut employees? I mean, research and development is a big cost for MSCI. They have improved their research and development cost since 2023, so more cost. Same thing for the SG&A segment. But apparently, with the use of AI, they can now develop new tools that will be more efficient, that will not need more employees. I mean, I can see this. If you go to financials segment, no, ratios, I can show you employee, total number of employees. Look at this. You haven't, where am I? No. This is the growth of the headcount employees since 2015. The CAGR has been 9%. So, what has been the growth rate? The growth rate of employees increased from 3% to 9% to 18% to 20% in 2023. Wow, in 2023, they hired 20% more people. And now what they are telling us is they have grown their headcount by only 2%. Look at this. This is in a quarterly metric. I suppose it was because of an acquisition here, but now they don't need, or it's not updated. We have the data until March 2025. So we don't have the latest quarter. I'm making this video too early for this website. In the last quarter, the growth rate of headcount was 5%, now it's 2%. Okay, you get my point. They need fewer employees to do the same amount of work. And this is a company still growing 10% per year. What if the efficiency continues because of better AI model? You will get better revenue per employee. You will get better free cash flow per employee. You will get all these better stats. If they don't need more employees, and free cash flow continues to go up, you will have a very, very efficient business model. Let me continue. Let me continue and see the report. What can I show you more? EBITDA margin more. Now you have some qualitative metrics. Management, reallocation of resources. They had maybe the biggest growth ever when it comes to ETF inflows. What can I show you? I can show you here, segment and KPIs. I can show you this, AUM in ETF. What they can show you, by the way, this is a recent KPI that was recently added to Fiscal AI. Congrats, Fiscal AI team. This is a great website you have. What you can see here, it's updated June 2025. This is the AUM, assets under management, that follows the MSCI benchmark, so the first index segment. If you want, if you want to know if this is important, you can check this. Asset-based fees. This is the asset-based fees for MSCI, and it represents 25% of the revenue. So 25% of the revenue from MSCI depends on the AUM. If markets go up, MSCI makes more money. It depends on the AUM. So as an MSCI shareholder, you want the company to make a lot of money. So you want the AUM to go up. And now in this report that was released in Q2 2025, they reported 17% growth in AUM, which is better than the organic growth, better than the earnings per share. You have a lot of inflows for ETFs. And they tell us the growth in revenue asset base, they say it was the best one out of all the indexes. Index run rate was this one, 17%. Where do I see 17%? Never mind. Okay. Let me just check AUM, you know what? MSCI delivered another strong quarter with 7% asset-based fee run rate growth fueled by record AUM levels in ETF products linked to our indexes. In fact, we saw more cash flows into equity ETFs tied to our indexes than any other index provider. Among client segment, we posted double-digit subscription run rate, blah, 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 blah. What they are telling you is you have an inflow of money towards MSCI World indices. So maybe there is an outflow from the US and more inflows into international markets. if you think the S&P 500 is overvalued right now, and if you think money will flow, capital will flow outside the US, MSCI is a good bet. Is a good investment for you. That's a very good way to look at MSCI. Yeah, actually, investing in MSCI is investing in diversification, international markets. And we reached the all-time highs in 2021 in AUM. It went down because markets went down in 2022. And now it's back to all-time highs. It will generate more revenue. Okay, let me continue in this segment. So for the recurring part of the business model, things are fine. For margins are expanding. And for the asset-based business model, things are fine. Things are at all-time highs, actually. So let me continue. Run rate, retention, we are still at 94%, so things are fine. Headcount is only growing 2%. Margins are expanding. Let me scroll down and see if I don't miss anything. Oh yeah, I want to talk about capital allocation, buybacks, and dividends. The guidance is intact. The capex is fine, and you have normally some tables here. What can you see here in the income statement of MSCI? Finally, after, I don't know how long I've been recording here, after some few minutes, we are looking at the income statement. Operating revenue, we don't have the growth rate. Oh, too bad. Anyway, we had a smaller income statement at the beginning of the document. That's the operating revenue, cost of revenue that went up accordingly. Maybe you can do a Google sheet, a Google slide, an Excel document to show you the year-over-year change for this one. You know what, can I do it? Okay, let's do it. Okay, here we are. I can zoom in a little bit so you see better. And I copy-pasted all this data for the income statement here. So we have this, and I want to show the change. This divided by this. All right. I want to have a percentage. -1, I would say. -1. So I have the growth rate. And if I scroll this down, here we are. Put this. All right. Wow. Okay. So the format is bad, but I will explain. Don't worry. Total operating expenses. Let me put this. Operating revenue. Let me put this. Net income. Let me put this. Earnings. Okay. We've talked about the margins before, so I will not put the margins. Okay. What you can see is for the revenue, as expected, it went up 9.1%. The cost of revenue, so the cost of operations, that's 7%. So the business is becoming more efficient. This is what we started this video with. The business has become more efficient, better margins. I showed you the stat for the past 20 years. The business is very efficient. Selling and marketing, you have an increase of 9% that matches the revenue. I suspect it's because they want to be more aggressive in their marketing to tap into new clients. This is also something that was mentioned in the goals here. They want to become a little bit more aggressive because they want to continue to grow. Okay, fair enough. That's not the biggest cost, but still to be considered. Research and development plus 7%, so similarly less growth than the revenue. General and administrative, this is pretty big actually. The general and administrative, including all the accounting stuff, administrative, legal, employees, was flat, was even negative. That's a cost, right? That's not a revenue stream. That's a cost that was stable year over year. So you can grow your revenue by 9% per year while reducing this line, less administrative costs, which is pretty good. I mean, AI can help them do this. Then you have amortization of intangibles and depreciation. These are small lines, so it doesn't matter much actually. This one is fine, 7%, and this one doesn't matter. What you mean is you can grow your revenue by 9% and grow your operating expenses by only 7%. This creates a 2% gap. This is the reason why the operating income is growing 11%. From 9% to 11%. Let me continue. Interest income. what is that? 6? No. Am I doing something right here? Last year, it was $6 million. Now it's $2 million. $3 million, sorry. It was an income. Okay, so generated. Oh, yes, they have less cash in the balance sheet. It's normal. Okay. It's a very small number anyway. Interest expense was flat. They have debt. And we've seen before that the debt level has not changed since 2022. So you have to pay an interest on the debt. Here we go. Flat. Okay, to be expected. This is very insignificant, quite small. Or the... Do I have the same line here? Maybe I did a mistake. Interest expense. Oh no, that's income and net. Oh, I see what I mean. Okay. This is not net. Yeah, what you mean is this is the net between interest expense, interest income, or the... Okay, anyway, doesn't matter much. Income before provisions, that went up 11%. I don't know if that's good or bad, actually, for the provision part. No, that's fine. Provision part increased 1%. Is it good or bad to have a flat provision for income taxes? I don't think that's relevant to the thesis. And it was flat. So the difference between EBIT, operating income, that you see here, and net income, the difference between the two is not the interest, it's the tax. The tax regime didn't match the growth rate for the business. So the business is growing, but the tax regime is flat. So I think the tax rate was lower. Let me check. Tax. Can I check tax here? Income tax. The effective tax rate was 19% compared to 21% last year. Okay, so I'm right here. Okay, and they expect the tax rate to be below 20%. So yeah, it will not revert to last year. It will stay down. Okay, fair enough. So taxes went down. This is the reason why the net income grew 14%. And they did some buybacks. So you go from 14 to 16%. They repurchased 2% of their shares. I can show you what I mean if I do this. Quarterly assets, no. That's the number of shares, I suppose. That's the diluted number of shares. You go from this to this. And here is your change. They repurchased 2.2% of their shares. So that's the difference between net income and earnings per share. See how efficient this business model is, right? By the way, you can have a business that can grow forever at 9 to 10%, improve the margins a little bit, improve the tax rate a little bit, improve the efficiency here and there, do some buybacks here and there, and you can grow your earnings per share by 16%. I mean, that sounds good to me. Let me scroll down a little bit. That's the balance sheet. Nothing to see here. They use some of the cash to do some dividends and buybacks. No goodwill, no major thing in the intangible assets, no major change in the long-term debt. The cash was used to do almost nothing. They have $300 million of net income, $300 million of operating activities, a little bit of capex, a tiny bit of capex, and most of the cash flows are used to do repurchase of stocks, small buybacks, small dividends, and that's it. They refinance their debt, like they repaid a little bit of the debt and they leveraged another time. So there is no change in the debt level. All of this to say, all of the cash flow is used to do dividends and buybacks. So literally the company is not doing anything, no acquisition, just rewarding shareholders. And let me show you something that no other YouTuber has shown you before. Now I have intrigued you. If you go to custom metrics, no, I can go to cash flow statements. If you check the repurchase of common stocks, the dividends, and the cash from operations, and the capex, you click on these 4 lines. You have this chart that nobody understands anything. You put this stacked bar chart. And here we go. In the upper side of this chart, in orange, you have the cash flow from operations for MSCI for the past 10 years. In orange, up and to the right, wonderful, right? In purple, in the middle, you have the capex. See how small the capex is. Actually, to be more true, I can use this also. Okay. The green and the purple here, this tiny purple, I can't even see it. That's the capex, very minimal. So that's a little bit how the cash is being used. How is the cash being used? In blue, in light blue, you have that's the dividends, up and to the right. What you see is roughly 1/3 of the cash flow from operations are used to pay dividends, to reward shareholders. And what is the most important part of the payment for shareholders? That's the buybacks. In dark blue, buybacks are almost as large as all the cash flows that the company generated. Look at this. I can remove everything and just show you the buybacks and the cash from operations. Look how big buybacks are. In 2015, the company generated $300 million and they did the buyback of double the size. Same thing in 2016. 2018, $6 million of cash generated, $900 million of buybacks. Same thing in 2020. Same thing in 2022. Even in 2022, they did more buybacks than the entire cash flow generation. And same thing in 2024, they are doing heavy buybacks. So the company doesn't need any capex. They don't need any costs. If AI will even add more efficiency, seems like the number of employees will gradually slow down, the speed of hiring, and they will use all the cash to do buybacks. Let me show you something else. I told you would have everything in this video. Don't forget to leave a like, by the way, for the algorithm, to tell me you've enjoyed this content so I can do more of this. And subscribe if you are not subscribed. I can show you the percentage of the cash flows, operating cash flows, that are used to pay dividends. 10 years ago, it was 20% of the cash flows that are being paid to dividends, and it went up to 30%, 35%. Now, buybacks. The percentage of cash flows that are used to do buybacks. Look at this. 200% of the free cash flow, of the operating cash flows. And now it's what? 60%, right? On a quarterly basis, here you are. The business for June. Oh, you have the most recent data. How great. For the operating cash flows, 40% of the operating cash flows were used to do dividends. And then another 40% was used to do buybacks. And the remaining 20% should be capex, right? Capex is 10%. The remaining 10% to do something else, right? This is not important. I mean, this is the minority, right? What moves the needle for cash flows and capital allocation are these three big lines, okay? Okay, let me continue to the report, but we are going towards the end of this video. Let me see if I can add some value here. At the end of the earnings call, the earnings call was not that important actually. They did some explanation about how they plan to reallocate capital, etc., continue the growth, etc. At the very end, and this is the only time I've seen this for MSCI, is at the ending remarks, the CEO of Henry Fernandez says, "We have demonstrated MSCI is an all-weather franchise, delivering very strong performance, sometimes in part of our business, blah, blah, blah. Every time, every couple of quarters, you have a comment. Every quarter, you have a comment." But one thing that is new to this earnings call was a lot of our new clients were very focused on, and so our franchise remains great and remains undervalued, in my view, as a large shareholder of the company. And we are looking forward to continuing to be a long-term compounder of earnings and growth in the years and decades to come. This last segment of the sentence He said it many times in the past. But this is the first time in a couple of quarters, I checked the past few quarters, that he clearly says the franchise is undervalued. He didn't say the stock was undervalued, and we can see it because they didn't pounce on the buyback program, but he says the franchise is undervalued. So the CEO is very confident in the long-term potential of MSCI. And if you look at the insider sales, the CEO, Henry Fernandez, bought more shares this year in February when the stock price was $570. And now the stock has dropped to $520. Can I see it? Insiders here. I want to see the buys. Henry Fernandez had bought some shares in here in February 2025 for $570. Yes. So the CEO is buying. The CEO is telling you the franchise is undervalued. The metrics are fine. The efficiency is fine. Things are moving in the right direction. The company wants to reallocate the resources to more profitable segments. So more cost toward the index. All the margins are going up. Things are in the right direction. And I think the drop in price is a panic mode that is not justified. And you want to see if I bought the stock or not. I bought the stock yesterday. Yesterday, it was the date of the report. So I bought the stock when it dropped 8%. And I think it's a good deal right now. It's a very good deal. And let me end this video by showing you the valuation of MSCI. Let me show you the valuation of MSCI to see if it's a good business or not. Let me check the forward valuation, forward PE ratio. Now, the forward PE ratio is 25. You have a business that is better than average with a forward PE ratio of 25. If you don't want the forward PE ratio, I can check the normal free cash flow. If you don't want the forward price to free cash flow, here we go. It's at 28. We are at the same level we had in April 2025 when everybody was panicking. It's the lowest valuation we've had since COVID at 28, at the bottom of the COVID crash. Even in 2019, it only reached 30 price to free cash flow 30. So if you take into account the growth of the company, we have a price to free cash flow of 25, which is the lowest point for the past 5 years. I think it's fairly valued. I think MSCI right now is not expensive, and I think it's undervalued. And I think it's a business that can continue to grow organically at 10% per year with a good capital allocation. Margins can improve. Free cash flow can improve. They will do dividends. They will do buybacks. You have a 1% dividend yield. So you have, as we said, I can show you what I mean. An earnings per share that can grow. I can show you the free cash flow. It will be even better because you have some tax change. A free cash flow for the past 10 years that has grown 18% per year. Add to this a dividend yield that is at 1.27%. So very good compound, very profitable, plus dividend yield available at a price to free cash flow of 28, forward price to free cash flow of 25. Sounds good to me. I've seen worse deals, and this is the reason why I'm buying MSCI heavily right now. And if you look at the DCF, and you want to forecast the future free cash flow of the business, I told you the free cash flow has grown by 18% per year for the past 10 years. So 17% per year, 16% per year. I can see a business that can grow earnings per share or even free cash flow by 15% per year for the next 5 years. I can put another assumption saying they will continue to repurchase 2% of their shares every year, a 2% buyback yield, right? 0 dividend growth rate, just for the sake of being conservative. And if you think this business can deserve a price to free cash flow of 30, here is your DCF. Here are all my assumptions. I estimate the fair value to be $750, which is 40% up from there. And if I buy right now at current prices, I can generate a CAGR of 17-18% per year. Now you start to see what I'm saying investing in MSCI. This is a business that is recurring, generating strong free cash flow growth, buying back their own shares. And if you buy right now, it can generate 18% per year. That's the life I chose as an investor, to focus on these quality businesses, these kind of investments that can outperform the market. I have no doubt that 17-18% per year can outperform the market. What if the growth rate is 12% and the price to free cash flow goes to 25% per year? You have a CAGR of 11% per year. Good enough. I don't think this company will grow at 12% per year. I think they can grow by more than this. The proof is they've done this before. And I don't think a price to free cash flow of 25 is enough for this business. This business is superior to normal businesses. It's better than average. It's better than the normal S&P 500, the average business in the S&P 500. So I think it deserves a higher valuation compared to the S&P 500. So this is the kind of analysis I do for all of the stocks I have in my portfolio. And this is the kind of analysis I teach my clients. So if you are watching this video and you want me to help you do this kind of analysis for your stocks and you want me to give you all the tools, I have a coaching program. And if you are watching this video and you want my help to outperform the market and do this kind of analysis, you can book a free strategy call with me. This is a link in the description. I have a coaching program. You can book a free, it's totally free, a free call. We will have a chat and discuss your situation. Where is your bottleneck? Where are your problems? And see if I can help you. And if I can help you, I will gladly help you improve your performance, improve your analytical skills. So if you are hesitating, just book a free call. I mean, you have nothing to lose, right? If we are not a good fit and I don't think I can help you, it's still a free call. We will have a lot of fun. We'll have a quick chat and I will give you free advice on your portfolio. So literally you have nothing to lose to book a free strategy call with me. And if you want more information about my coaching program, I believe you will have a link in the description to see more testimonials, what we work on the community. We analyze businesses together. We focus on key stocks that are interesting at the moment, undervalued opportunities, how to build a great portfolio that outperforms the market. These are all the tools I teach my clients. And I believe if you follow all these tools, all these steps, all this analysis, you have all the odds to outperform the market in the long term. So if you are motivated and serious about beating the market and being a great investor, improve your investing skills, you can book a free call with me and I'll see you on the other side.